We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Think about the major choices you've made in your life. Picking a career, choosing a life partner, deciding to have children, changing jobs. These are high-stake decisions because each forces you to set aside all possible futures except the one you ultimately choose. Of course, any potential future is completely unknowable in the present moment. But the act of choosing something, even if we don't know whether it's right or wrong, optimal or less so, gives us a sense of control and responsibility over the decision. When outcomes eventually reveal themselves, it's easy to feel regret when they aren't what we hoped or expected. And regret can be really painful. For me, when I experience regret, it's not just in my head. It feels like my heart swells up and makes it harder to breathe. It's not pleasant, and it's obviously something I'd prefer to avoid. While I unfortunately don't have the answers for minimizing regret you could feel about those big life choices, I do have some wisdom to offer for investing. To start, it helps to understand where regret often comes from and why we experience it. We often feel regret when we can clearly envision the alternative paths we didn't take and decide those paths would have been better than the one we ultimately chose. I was recently on another podcast where I gave an example of choosing an ice cream flavor while I was on vacation with my family in Michigan. My parents, my sister and her family, and my family, not every summer, but pretty frequently, will go to South Haven, Michigan. And there's a little ice cream shop a few blocks away from where we stay. And every night, the whole family after dinner goes and walks and gets ice cream cones. And while the family is walking to the ice cream shop, people are frequently discussing what ice cream flavor they're going to get that night. For me, I don't get ice cream every night. I do get it a couple nights, but I'm a bit of a calorie counter. And it's mostly because there's some days where I'd rather have an extra cheeseburger than an ice cream cone. But I do get it once or twice over the course of a week. And I remember the last time we went, we're walking there and we're talking about all the different flavors, and everybody is agreeing that Mackinac Island fudge is the best flavor that's there. And we get into the ice cream shop, and I ask for a sample of it. You get one of those little spoons, take a taste, and I think, yeah, this is pretty good. And so I decide to get a scoop of that, even though there's something called chocolate malt that I think I would like a lot better. But everybody agrees this is the best flavor. So we're walking back, and I'm eating my ice cream. I'm thinking, this is not that great. And I ultimately regretted the decision because the next night when we go and get the different ice creams, I'm not getting ice cream. I know I only have a couple nights that I'm going to get it because there's other things that I want to spend those valuable calories on. But I could see the alternative choice. That regret is so much more powerful when we can clearly envision those alternative choices and think about how they might have been better than the one we ultimately chose. Now, of course, the regret from smaller decisions, such as choosing an ice cream flavor, is going to be far more fleeting than, say, choosing a career or choosing a spouse. But yet, we still seek to minimize regret in situations like ordering a familiar flavor of ice cream that we know we like rather than ordering something new. And by the way, I think those little spoons that they give you samples can make it worse because you're tasting all the different things. Again, it helps you clearly picture the alternatives. And maybe something's good for a bite or two, but not as good for a whole scoop. And as I'm rambling on here about ice cream, maybe my personal choices of ice cream is not so fleeting after all. But I do realize that I do the same thing in restaurants, where I order the same dish every time once I've found something I really like. And I return to that restaurant and I see other things on the menu that are probably very good. And I've even heard people say are very good. But I know I like this one dish, and so I just keep getting it. But again, choosing the less than optimal choice in these situations is harder to notice over the long term, and certainly the penalty is far less. With investing, it's really easy to see the alternatives after the fact. Winning investments always find their way to the center of attention. They're the subject of financial news segments, they're in social media posts, and they're even a part of conversations with friends or family or coworkers. Investing is also highly quantifiable, which can lead us to believe there's always an objectively optimal decision out there. If we spend just enough time thinking or researching or looking, we can find it. And if there's an optimal choice, then naturally it feels like there's also a wrong one. And knowing that things can go wrong leads a lot of people to put extra pressure on themselves to get it right. Of course, this is largely an illusion. There's no perfect portfolio. We can't know in advance what strategies or asset classes will win over any given period of time. So if we're kicking ourselves for missing an obvious opportunity, it's probably because we conveniently thought it was only obvious after the fact. This sort of hindsight-biased line of thinking is a normal working part of the human memory, but it's a feature that often causes a lot of unnecessary grief in the investment experience and can really intensify those feelings of regret. So how do you minimize regret with your investment decisions? When I'm having these conversations with clients, I always find that it's useful to think about how you might feel in the future about the choices you make today with your portfolio. Ask yourself, in 10 years, what would make me regret this decision? What are some of the ways this decision could lead to bad outcomes? And how would I feel in these scenarios? It's also helpful to think deeply about whether you're more concerned about implementing a bad idea or missing out on a good one. When the FDA evaluates a new drug, for example, they seek to minimize the chance of approving a drug that's not beneficial to people's health or causes bad side effects. And in doing so, they simultaneously increase the probability of failing to approve a drug that would improve people's health. It's a choice that we talk about internally as making a type 1 error or a type 2 error. And when you minimize one, it leads to a higher chance of realizing the other. The FDA, they're managing this trade-off when they're approving safe drugs for the public, and investors have to do this when determining the best strategy to use for their situation. As you think about what would cause more pain, making a bad investment or missing out on a good one, you have to remember that bad outcomes are not always the result of a bad decision. Sometimes you just get unlucky or the probabilities don't work out in your favor. That's why no investment action should be taken unless it's adequately supported by good evidence. Of course, that also requires that you have a good process for interpreting the evidence you have. Let's walk through a specific example to see how an evidence-based decision-making process can maybe help reduce regret. Specifically, I'm going to highlight the choice to own international stocks. Now, the case for owning international stocks centers on diversification. To me, it's less about directly increasing return and more about reducing risk or volatility, which ideally improves the amount of return you earn for the degree of volatility you assume over time. This is what asset allocators like myself refer to as improving the risk-adjusted return. And all else being equal, when comparing two portfolios with the same average annual return, the one with lower volatility is going to have higher compounded returns over time because compound interest works better with lower volatility returns. So by owning assets that don't move up and down in perfect tandem, in other words, by diversifying our holdings, we can reduce the overall volatility of the portfolio and, all else equal, increase its compounded returns. By definition, good diversification means always owning some losing investments in your portfolio. You know in advance that by choosing to be a diversified investor, you will undoubtedly always have a part of your portfolio that disappoints. This means that whether or not you'll regret owning a globally diversified portfolio could depend on whether you focus more on whether the ultimate outcome was good or bad, rather than being concerned whether the decision-making process itself was good or bad. To minimize regret, I think it helps to evaluate the process by which you made these decisions. In this case, understanding the reasoning and math behind diversification, rather than focusing on specific outcomes, like, for example, the fact that international stocks have lagged the S&P 500 over the last decade. When you focus on outcomes rather than the process, that increases the opportunity for regret. So if you find yourself regretting ownership of international stocks due to their relative underperformance in the past decade, then you might be unfairly assuming that the bad outcome was the result of a bad decision. Evaluating the quality of a decision based on its outcome sets you up to experience more regret than's necessary because risk and randomness can make even the best decisions yield bad results. It also assumes a binary that isn't actually there. There's not just a best decision and the wrong one. There's usually a second best choice and a third, and so on. Using probability is the only rational way to make decisions about an unknowable future. So if we go back to this idea of global diversification, the evidence shows us it's a strategy with a very high probability of improving risk-adjusted returns. Higher probability, however, doesn't mean guaranteed. And something like risk-adjusted returns is not necessarily something that everyone understands. So if you don't understand why you're doing something, if you don't understand the thesis and the process and the underlying evidence, it can make it very hard to sit with. Now, the idea of global diversification, if you're thinking it's just going to completely enhance returns, is naturally going to turn up to not look like the very best choice at all times. But under the case of it's improving diversification and it's improving risk-adjusted returns, financial theory tends to work pretty well if you give it enough time. And while owning international stocks didn't add to returns over the last decade, they were additive over the past 20 years, which is a time horizon that I think is more academically aligned with the phrase long-term. After all, we're long-term investors here. And if we look at the choice to own international stocks a decade ago, we evaluate the evidence that you had at the time and you take a close look at the decision-making process, that would be the real way to assess the decision. And interestingly, when I think back to a decade ago, the people who were looking to make a change in their portfolio were often clamoring for more international and emerging market exposure because we had just experienced this 10-year period from 2000 through 2009 where the S&P 500 had a negative average annualized return. Now, in my everyday experience, whether it's talking to clients or family or friends, investors that were disappointed by having less international exposure a decade ago are often the same ones that were disappointed by not having more U.S. exposure today. This highlights the importance of another piece of thinking probabilistically, and that's understanding the thesis and the range of outcomes of a particular strategy in advance. So if you added international in 2010 because it had better performance and you were hoping the change would increase your returns, you had a bad outcome and a bad process. But owning international for the purposes of diversification is a totally different story. Knowing a sound investment process is in place ought to minimize regret by providing the mental bandwidth to acknowledge a bad outcome wasn't necessarily the result of a poor decision. Now, the opportunity for experiencing regret as an investor expands well beyond global diversification. You need to have a good decision-making process for a number of choices you'll face over the course of a lifetime, such as, should I invest my cash in the stock market right now? Should I overweight my portfolio to value stocks and underweight to growth stocks to seek higher expected returns? Should I replace my bonds with a higher yielding alternative? Should I invest in Bitcoin? Should I invest in an ESG portfolio, an environmental, social, and governance conscious portfolio to more closely align my portfolio with my values? There's always going to be a best or optimal answer to these questions after the fact. But remember, you can minimize regret by understanding the evidence supporting a decision, using a probabilistic approach, and thinking through how you might feel about the variety of potential outcomes. And once you minimize regret, it's much easier to stay the course and let financial theory do its thing over the long term. Today's question I'm going to address, I think, sort of aligns with this idea of minimizing regret. And as a reminder, you can visit thelongterminvestor.com to submit questions for me to answer on the podcast. I'll also be answering questions on the podcast that are submitted to me through my blog or that people respond to my emails with simple questions. I'll definitely answer those. And today, the question is about the stock market and its current valuation. So I'm going to read the question here. Do you think the stock market is in a bubble? It doesn't make sense to me why it would be up given all the problems our country faces. I've been thinking about paring back my equity exposure because it seems like we must be due for a correction. So I don't love the term bubble, in part because I feel like it gets way overused. Part of what makes something a bubble is that it isn't easily identified in advance. The question here, it's pretty broad in the concern of the, quote, the problems our country faces, but those are all pretty well known. They're probably priced into the market. And I've certainly heard specific concerns from clients, family, friends about our country or some specifics of the economy or politics. But again, rarely do I hear anyone raise an issue that isn't already well known among market participants. I really like the way that Cliff Asness defines a bubble. He says, quote, the term should indicate a price that no reasonable future outcome can justify, end quote. I'm not sure that stocks are at prices that fit this definition. And part of me wonders if it's just simply a lack of understanding of how markets work that drives the doubt and the apprehension about the stock market today. Remember, market prices are set on a basis of supply and demand. You have millions of market participants trading billions of dollars a day, and they're taking all the available information. And there is a lot of information out there. It's what you read in the paper, what companies are releasing in earnings reports, but there's also more specialized data like satellite imagery or custom data sets that are privately owned by those seeking to profit from them. And when people take all that information, they make an assumption about what a fair value of price is. And when there's more buyers than sellers, that means that people think prices should be higher. And as a result, prices go up when there's more buyers than sellers. It's supply and demand. So when you see that the market is up in a day, basically what has happened is that the market thinks that profits will be higher in the future, or due to supply and demand, they're willing to pay more for those future profits than the day before. When you break down returns, good or bad, you can attribute them to three things. The first is changes in earnings, which I think makes intuitive sense because the more companies are earning, the more you would think that a stock price is worth. The second is reinvested dividends, which can be in the form of share buybacks, or it's just the actual dividends that you reinvest. And then the third, and probably the most uncertain, but also pretty important, are changes in valuation. And that's really a measure that blends psychology and calculus. You have all these investors trying to predict future cash flows to determine what different companies are worth today. But the confidence that they have at any given time, collectively or individually, can really impact how much someone is willing to pay for those future earnings. And that's where the psychology kicks in. This psychology can cause investors to pay more or less for the same dollar of earnings on any given day. So when you're trying to understand why stock returns are the way they are over the past year, the past 10 years, or I guess theoretically within the past day, it's changes in earnings, the impact from reinvested dividends, and changes in valuation. So think about this framework when you're trying to understand why market prices are where they are today, or any time for that matter. Now, so far, I've mostly focused on the bubble aspect of this question, but I think that we can actually think a little bit about minimizing regret when addressing the comment about paring back stock exposure, because it feels like we are, quote, due for a correction. So as a CIO at a large firm like Plancorp, plus being in the media, as well as being questioned pretty regularly by family and friends, I always feel like I'm talking to someone who feels like we're due for a correction. And I'll admit, I have been hearing this concern a little bit more recently. But here's typically what I ask people concerned about a correction. How big of a correction are you expecting? Because typically 10% drops occur on average every 12 months, roughly. So if you're worried about a 10% drop, that's sort of the cost of equity investing. You have to have some uncertainty, some volatility in exchange for the higher expected returns that stocks provide. If you're worried about a 20% drop, just realize that on average, those happen roughly every 3.5 years. Again, roughly. And it's not like these things operate on a schedule. And again, I'd say this is mostly the cost of investing. You have to be willing to tolerate these types of losses in order to earn the higher returns that stocks offer. Long-term investors have to know that a 20% drop, while perhaps frightening in the moment and unique from past 20% drops, is incredibly normal. Now, the 30+% drops, on average, those happen roughly once a decade. And again, I'm just talking about averages here. But these types of drops tend to happen for reasons that are completely unpredictable. So ask yourself, when you're worried about a correction, how big of a drop? And how long until it recovers? Are you worried about a permanent 40% decline? Because the probability for that kind of permanent loss for a globally diversified portfolio is extremely low. And let's say you do sell out of stocks, or you do reduce stock exposure from, say, a 70-30 portfolio, stocks to bonds, to a 50-50 or a 40-60 or whatever. How will you know when to ramp stocks back up to your original allocation? See, that's the hard thing about timing the market. You have to time it right twice. And also, there might be taxes. I live in St. Louis, and with Missouri's state tax rate plus the highest capital gains tax rate plus the investment income tax, that means that you would pay almost 30% in taxes when you realize long-term capital gains, which if you're in a state with higher taxes, Missouri's 6%, but if you're in a state that has double-digit tax rates, this is going to make a really big difference. It's one thing to realize taxes as part of a financial plan that requires you to liquidate part of your portfolio to meet living expenses. But timing the market to try and avoid a loss, and in the process suffering from your own personal bear market that the taxes create. Plus, remember your time horizon. What's the money for? It's unlikely you need to liquidate your entire portfolio to meet your living expenses. If you're saving for retirement, short-term declines in the market, even if those, quote, short-term declines take a year or two to recover, means that you're probably better off riding the market waves up and down. I think the same thing goes for portfolios that are intended for the next generation. So if you're in retirement and you know that you're not going to spend down your entire portfolio in your lifetime and that your heirs are going to be the ones inheriting the money, then your time horizon is actually partially aligned with their time horizon. And for younger investors with multiple decades until retirement, you're definitely better off riding the market's ups and downs instead of trying to predict when a market decline is coming. We never know when the next correction or bear market's going to occur, but we should expect them to continue occurring with a similar frequency and magnitude as they have in the past. And that means we can plan for them. And it's much better to plan than to predict. For show notes, free resources, and a place to submit questions, please visit thelongterminvestor.com. If you enjoy the show, you can subscribe wherever you listen to podcasts, and please leave me a review. I read every single one, and I really appreciate you taking the time to let me know what you think. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.